Hi, good afternoon on this post-budget talk. We are examining the impact of the Union Budget 2018 on the capital market, on the economy, and on what will happen to the portfolio of investor and how should one go about investing going forward. As expected, the budget is focusing on the area in which the current dispensation think is that they need to focus more because the Gujarat election has given the signal that rural India is under a little bit of distress. So there's a lot of focus on rural India. The impact of that is that the MSP, the minimum support price for the food grain, would be 50% of the cost. So in our opinion, from current MSP, the MSP price is going to go up by 10 to 15%. So to that extent, it will remain inflationary. It will create more inflation in the economy. But the flip side is that this will lead to a lot of money in the hand of rural India, and that would lead to consumption, and that will lead to growth in the profit of various companies. So that is the one focus area of the budget. The second focus area of the budget is that a very ambitious health scheme in which close to 10 crore families would be covered. So around 40% of India's population will get covered. So we believe that it is a very historical decision the government has taken. We need to see final shape in which the scheme comes out. Most probably it will be a bidding would be done by the government in which a lot of private and public insurance companies would participate. So it is a good thing for rural economy as well, and this will also lead to a consumption. It is also good for the urban poor because now they have a safety net of up to 5 lakh rupees for hospitalization per year. So the discretionary spending to certain extent would go up even in that segment of the economy. This is also going to be good news for the general insurance business as well because if these families started getting used to insurance product, then when they go up in the income level, I think they will start buying insurance product, and some families will think that 5 lakh is not enough, so they'll perhaps look at increasing the health insurance cover. So it is going to be good news for the health insurance company. It is also going to be good news for the medical care industry in which hospitals and pharmaceutical industry will benefit. So all in all, this will be very good for the economy. We need to see how the budget layout is planned for these activity. Right now, in this budget, the government has provided 2,000 crore rupees. We need to see what would be the actual quantum of money which would be needed for this. The third is that there's a huge infrastructure focus. So there's allocation in railway for railways, for ports, for roads, and for airports. And I think all of them would lead to big infrastructure spending in India over coming years. So from an economic perspective, all in all, it is a very good budget in my opinion. Every government have their hands tied because they need to keep juggling between the various pressing needs with various constituents demand and the tax collection. So keeping these things in mind, I think it is a very balanced budget. So this is a budget very clearly looking at 2019 election, and any political dispensation would have done the similar kind of thing which this government is doing. Continuous the government the present government focus is very clearly to curtail the unorganized economy or the unaccounted economy, and the focus continues, and this will lead to more money coming into financial assets, so be it banking industry, NBFC, be it mutual fund or life insurance company, the flow will continue in my opinion. So from that perspective, there's a continuity of thread, and even if there's a government change, I don't think the policies of putting more restriction on unaccounted money will stop, and I think it will continue whichever government come into power. So this is about the broad theme of the budget has been. Now, if you look at the impact of this on the capital market, if you look at equity market is no longer in cheap zone. It is not even average zone. It is slightly above the long-term averages, and it is being justified on the ground that in last 10 year the GDP expansion happened around 10 to 11% in absolute term, but the corporate earning growth has been 6% on an average. So corporate profit as a percent of GDP has come down from 7% to less than 3%. So it means that GDP has expanded, but the corporate profit has not gone up. So the market is anticipating that last 10 years averages, which was below long-term averages. So it means that the average is going to go up. It means the corporate profit is going to go up from these level. And that is the reason that we have 27 kind of P multiple in the market. So there's expectation of earning growth, and whatever number we have seen for September quarter and even for December 2017 quarter, the numbers are looking very good. So the corporate profit is going to go up. So uh, we do not see this market in the bubble zone at all. We see this market is from a reasonably priced to little overpriced, but definitely there's a froth, little bit froth in the mid and small cap stocks, and that is the reason that at Buckfast for last 6 months we have been not advising people to invest in mid cap and small cap stocks, and we have been telling people to invest more in multi cap strategy. In particular, last 3 months we have been telling people to put focus more on investing in balance fund and investing in dynamic equity fund or various mutual funds. So we continue to focus on these things. We believe that even going forward, if you have to invest in equities, your view has to be minimum 5 years. Else, you could look at investing in balance fund or you could look at investing in dynamic fund. What we have also seen very interesting is that the interest rate in the economy has gone up from 6.5% to close to 7.6%. So there's a 1% increase in interest rate. So it means that the debt market has gone down 15% in last 1 year. Now think of equity market. Suppose the Nifty tank 15%, what will happen today? But we have seen bond market is going down by 15%. So from that perspective, bond market is in bear market. So whenever we are in a bear market, what one should do is to look at investing in that asset category. So in our opinion, one should look at investing staggered allocation into long dated funds. So a well managed dynamic bond fund over the next 24 to 36 months will outperform any other debt category in our opinion. So if you have money, I think some part of the allocation should go to dynamic bond fund. We already started this around 1 month back, and we have been telling people to start looking at investing in dynamic bond fund. A well managed dynamic bond fund will do very well for investor. So investors should start allocating gradually in dynamic bond fund category. As far as equity market is concerned, we believe that the the market may see some correction, which is a healthy correction, and that keep happening on regular basis. So we don't see anything abnormal happening on equity market right now. So we believe that one could take advantage of this fall in the market and could look at doing allocation if the market continue to go down 5%, 6%, 7%, because any fall in the market is a potential gain for investor. So this is my brief summing of the budget. If you have any question, I'm more than happy to take those questions.
So, what do you think? What will be the impact of mutual funds on post budget?
The question was that what would be the impact post budget on mutual fund? As we know that there's an introduction of long-term capital gain tax of 10% on mutual funds. So it means that, and they have put a grandfathering clause of 31st January 2018. So if you bought anything before 31st January 2018 and on 31st January there's some price. So the price on 31st January or the price at which you bought, higher of that will be taken as a cost of acquisition, and after that any gain will be tax. So, for instance, if you bought something 1 year back at 100 rupees, and on 31st January 2018, the price is 125, and suppose on in April 2018, the price become 140, and if you sell at 140, so from 100 to 125, there'll be no capital gain tax. From 125 to 140, you have 15 rupees gain. On that 15 rupees, you need to pay 1.5%, sorry, 10% tax. That is going to be 1.5%, 1.5 rupees around that number. So that is what is going to happen on equity mutual fund. On uh, arbitrage fund and equity saving fund, there's a 10% dividend distribution tax. So the equity arbitrage fund dividend used to be completely tax free, but now it is going to get tax at the rate of 10%. But don't worry, because the equity arbitrage funds return has gone up from 5.5% to close to 6 to a quarter or 6.5% in last 3-4 months, because interest in the economy has gone up. So both on equity saving fund and equity arbitrage fund, 10% tax is nothing, and one should look at continue to invest in these funds. At Buckfast, we never recommended dividend plan in equity and equity oriented funds, because we believe that if you take dividend out of a growth asset, then you are not allowing the growth asset to appreciate, and you're dipping into too early. So we were never a marketeer of a dividend plan in balance fund or equity fund, and we continue to believe that one should not take dividend option in the balance and equity oriented fund. So we believe that one should look at investing in a growth fund. We have designed a way in which you could look at, even in this market condition, you could look at gaining amount, you could look at in this market a gain which are pre-budget gain, and I'll explain in later part of my speech on this as well.
Sir, how should we plan our investment for 2018? Like we should wait for more correction or we can start investing now?
See, nobody, the question was that how should one look at planning their investment? Should one look at waiting for the correction, or should one look at investing on continuous basis? Absolute market level in short term, nobody knows. So what should you do in this kind of situation? Our recommendation is that if you are too worried about the market, then invest in dynamic equity fund or various mutual fund, or you could look at investing in balance fund. The advantage of balance fund is the portfolio manager need to reallocate allocation every month. So if the market goes down, he invest more in equity. If the market goes up, he sell equities, which normal investor cannot do in their own ways on regular basis. So one should look at these two products. If you want to invest in equities, then you should look at putting money into equity arbitrage fund or liquid fund and transfer on regular basis into equity fund. So you get allocation at various market level, and that is a much better strategy. At Buckfast, we have been constantly advising investor to follow this strategy. And in between, suppose the market correct more than 10%, then you can do more allocation in the market.
So, will equity investment be still attractive after introduction of long-term gain, as volatility is considered as a major problem there? So,
Yes, equity will remain an attractive investment option. I found it very ironic that before the budget, people used to worry about the market corrections as if they are going to lose capital, and now they're worrying about the gain on tax. So it's a bit ironic, but still. So in my opinion, the 10% capital gain tax is not a very high tax rate. Pre 2004, capital gain used to be 10% plus. So we are back to those level. If you look at global market, I don't think in any major economy equity gains are completely tax free. So India has, we spoiled ourselves thinking that capital gain is going to be completely tax free in equity from 2004 to 2017. We have a 13 years period in which we never paid tax except STT. So in spite of 10% capital gain tax, equity will remain a very attractive investment option, because in absolute term equity will continue to outperform all other asset category. For instance, if you look at alternate like fixed income product like FDs, the tax rate is depend on at what marginal tax rate you falls in. If you look at real estate, the transaction cost itself is very high. If you look at gold, there's a tax when you buy or sell gold as well, and then there's a long-term, short-term capital gain. So if you compare to any other asset category, uh, we are equity will remain very attractive investment option. The challenge is not compared to other asset categories. The challenge is compared to what happened in past. So I remember when Sachin Tendulkar continued to play, and even he not used to play according to his high standard, but even at the rate he was playing, he was the best batsman in the team. But he was not compared with other batsmen, but he was compared with himself. So same thing is happening in equities, that we are comparing equity with the tax free, but you compare equity with what alternate you have. So in my opinion, equity will remain and continue to remain a very good investment option.
So people usually go for balance fund with dividend option after the introduction of DDT. What do you think the existing investors who have invested in balance fund with dividend as their option, what should their strategy be now?
First of all, anybody who has a dividend option in equity should move out from that option and move to growth option as soon as possible. And every investor should examine their own, uh, uh, talk to their own tax advisor and take the opinion that when they have invested, at what NAV they have invested, and what is NAV today, and what is the exit load and all that. Keeping these thing in mind, in my opinion, if your investment in dividend option is more than 1 year, then transfer that money immediately into growth option.
Thank you, sir.
Thank you, sir.
One more thing, as I told you that in this budget, how you can take advantage of having the similar kind of gain. So let's take this illustration. Let's look at 31st January 2018 when the Nifty was 11,026. Now let's look at last 20 years return of Nifty. So from where the Nifty return has come, last 20-year average Nifty return has been 13.4%. And this 13.4% actually is Nifty return comprises of 11.90% Nifty return plus 1.5% dividend yield. So that makes 13.40. If you look at GDP plus inflation for last 20 years, the number is close to 13.4%. So GDP plus inflation is equal to Nifty return plus dividend yield. So if you look at that metric, it means that for next 10, 15, 20 years, what kind of Nifty return will come by? So Nifty will generate return close to GDP number plus inflation. Now, what is the expectation of GDP? Let's assume it is close to 7%. What is the assumption about inflation? Let's is close to 5%. So 7 plus 5, 12. So 12% is a kind of growth we see in Nifty earning. At the current market level, the Nifty EPS is 401 rupees. If you multiply this by 12% per annum for next 5 years, 7 years, 10 years and 20 years, you can put the Nifty EPS. Now look at the P multiple of Nifty. Right now the P multiple of Nifty is 27. But let's look at the long-term average of P multiple, which is close to 19. So let's look at 20 P multiple. If you take 20 P multiple, then after 5 years, Nifty will have certain numbers, 7 years, 10 years, 15 years and 20 years. And we are putting this chart along with this stock. If you look at that number, then if you invest in Nifty at the level which we are recommending in this chart, you will figure out that you will continue to have the same kind of gain which you used to had earlier before the long-term capital gain has been introduced in this budget. So for instance, if you look at a 12% earning growth, then after 5 years, Nifty would be around 14,133 level. The Nifty level on 31st January is 11,000. So pre-budget gain of 3,106. Tax, current tax is 10.4%. So post-tax, your earning is 3,106. Now, if you have to make money next 5 year, and if Nifty goes to 14,000 level, then entry level, in our opinion, for next 5 year could be at the Nifty level of 10,666. If you invest at 10,666 and from these level the Nifty earning growth grows by 12% and Nifty quote at 20p multiple, then even after paying 10.4% capital gain tax, your post gain will be equal to pre-budget gain. If you look at for next 10 year, in our opinion, if the Nifty earning grows at 12% and P multiple is close to 20, then Nifty would be around 25,000 level. The Nifty level on 31st January 2018 is 11,000. So pre-budget gain of around 14,000. So on that you earn 13,881 rupees. For instance, you bought 1 unit of Nifty and on that pre-budget you pay 1444 as a long-term capital gain. So if you have to make similar kind of gain, then the entry level of Nifty could be 9,416 and for 7 year period is 10,249. A detailed note would follow with this stock, so you can look at these number. So at Buckfast we figured out that you can beat the long-term capital gain blue by investing at the Nifty level, which we are recommending to an investor. Thank you very much to all of you for listening to this communication.